You're coming up on late morning on Wall Street, and it's time for a quick reset. I'm Grant Mercer, this is Storm Stock Solutions, and we're here to keep some clarity through the chaos of today's tape. The tone this hour is cautious, but curious. The big narrative turning heads, according to MarketWatch reporting, is a former commodity trader warning about the potential for a second wave of inflation, drawing parallels to the 1970s. That's the kind of macro chatter that doesn't move the indices instantly, but it does get professionals rethinking how comfortable they are with today's inflation is dead consensus, especially in energy and commodity-linked names. Alongside that macro debate, Morgan Stanley's analysts, in a separate piece highlighted by MarketWatch, are laying out a list of macro surprises that could trip up investors next year. When you combine those two storylines, you get one clear theme this hour. The market is starting to game out what happens if 2026 doesn't look as smooth as the base case built into current valuations. That often translates into more attention on rate expectations, the dollar, and cyclicals versus defensives, even if prices haven't broken in a big way yet. On the stock-specific side, there are a couple of clear areas of strength professionals are watching. First, tech and software get a psychological boost from an interview with Okta CEO Todd McKinnon, who's urging caution for people racing to jump ship into hot AI startups. The story itself is more career advice than earnings news, but it underlines a broader market theme. We've seen this movie before in the dot-com era, and disciplined operators can outlast the hype cycle. Traders in established software and cybersecurity names will be watching whether this kind of narrative slowly shifts attention back from tiny speculative AI plays to companies with real cash flow and customer bases. Media is another bright spot in the headlines. Paramount's aggressive push for Warner Bros. Discovery's back in focus after the company said Larry Ellison is now personally guaranteeing $40 billion of the financing behind its roughly $108 billion offer. MarketWatch notes that level of personal backing is unusual and sends a strong signal of conviction. For the tape, that means continued speculation in the traditional media complex, Paramount, Warner Bros., Discovery, and even the big streamers, as traders handicap who ultimately controls content versus big tech, and at what price. On the flip side, one clear weak spot to handle with care this hour is Honeywell. Reporting from MarketWatch details a $400 million one-time cash settlement tied to the FlexJet lawsuit, alongside a lowered profit outlook. That's the kind of combination, legal overhang plus guidance pressure, that tends to weigh on sentiment, not just for Honeywell but sometimes across industrials and aerospace peers as investors ask whether other balance sheets might be hiding similar surprises. Positioning-wise, this is a reminder that even high-quality, diversified names can face idiosyncratic hits that knock earnings trajectories off course. In the background, we've got a few under-the-radar stories that are more about portfolio construction than short-term trades. One MarketWatch column points out that hedge funds on average have underperformed a basic 60-40 stock-bond portfolio, even as access to these elite strategies has expanded for a broader set of investors. That's not a call to buy or avoid anything, but it is a useful reminder for longer-term folks to watch fees, benchmarks, and whether complexity is actually delivering excess return. And there are a pair of personal finance stories trending, very different situations, from a couple worried about homelessness with just $100,000 saved to another with $1.53 million in IRS debating whether they can retire next year. They're not trading catalysts, but they underscore a key backdrop to this market. The gap between financial insecurity and financial comfort is wide, and that influences everything from consumer confidence to how aggressively households participate. In equities, one more human behavior note. MarketWatch is also highlighting research showing that younger crypto holders with full-time jobs and college degrees have much higher gambling participation than non-crypto holders. Again, not a direct ETF driver, but it speaks to risk appetite at the margins, and to why some corners of this market can move far more violently than the fundamentals alone would suggest. Into the next hour, I'll be watching how this inflation, second wave narrative feeds into rate expectations and whether industrial names stabilize after the Honeywell news, or see more follow-through selling. I'll also keep an eye on any price action around the Paramount, Warner Bros. Storyline as deal details evolve, We'll have more for you in the next update, and then a full wrap at the close. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer. Stay sharp, stay steady. Stay what?